And remember also that if there's a, if there's a bankruptcy, not every bankruptcy happens right away. So, the sooner you file the lien, the better. If you do file the lien and the bankruptcy is filed within 90 days, the lien's going to be on round two. But it does help as a protective measure.
So if there's nothing else on this point, and then of course, you want to protect your, Todd, you wanted to say something?
Yes, if I may.
Sure, absolutely.
Question, because we obviously have been spending a lot of time talking about that. The question is, if the tenant rep broker has a co-brokerage agreement with the landlord's agent and not directly with the landlord, we were told that the tenant rep broker cannot sue the landlord to file a lien because it's a contractual matter between the landlord's agent, who's acting as a fiduciary, and the tenant rep broker. Since the court would say there's no direct relationship with the landlord.
Yeah, that's a good point, Todd. And usually those agreements have a pay if paid clause in them, right? Because they're only obligated to pay you if they get paid. So that's a very good point.
Any suggestions on how to try to address that in a brokerage agreement to give us more protection if there is a landlord's agent that's signing the document?
Can I give that some more thought and get back to you?
Please, thank you.
Well, I've seen in previous brokerage agreements that if they don't get paid, that the tenant rep has the right to go after the landlord.
Right, but the question is whether or not, if there's no relationship between the tenant rep broker and the landlord, it's sort of like a frivolous lawsuit, if you will. Meaning,
yeah,
there's no contractual agreement between the landlord and the tenant rep directly.
Yeah.
I don't know. Does anyone get guarantees? I don't know.
Yeah. Todd, we'll get back to you with a workaround on that.
Thank you.
All right. Moving along.
So of course you also want to secure your client on that they get building services, and that the TI allowance gets funded. So we talked about the fact that there could be likely be a TI reserve with the lender. You evaluate the status of that. And of course, if building services fail, the untenantability clause is pretty accepted in the market, that if there's a period of time that services fail and the tenant can't occupy and doesn't occupy, then rent abates, at least fixed rent. And of course, from the landlord owner point of view, the owner is not the guarantor of the electrical grid. So those clauses are typically limited to things that are within the landlord's control. And if there's a general, power outage or catastrophic event, clause doesn't apply. And then, of course, if the landlord doesn't fund the TI allowance and there's no good faith dispute, tenants often negotiate offset rights because otherwise to sue for that money is difficult. So those are a couple of ways to protect your tenant in the lease against failure of services there. Looking at this challenging environment from the owner's perspective.
Michael, can I just pause you for just a second on that?
Please, Kirk.
On the tenant offset rights, of course, from the tenant's perspective, you want a non-disturbance agreement from the lender, right? And what you really want to do is make sure that the lender recognizes specifically the tenant's right to offset for TI. Okay, and if you really want to, be a little bit more exacting, not only can you offset for the actual cost, but maybe also for interest as well. And of course, the lender will push back when you're going into the relationship, but you want to protect that for the you want the non-disclosure for foreclosure by the lender, obviously as well for a bankruptcy.
Yeah, those are really good points, Kirk. And like you said, you're going to have to persevere, right, to win them, because the lenders will push back in the first instance. So that is a good point.
What about offsetting for the commission?
Well, again, the non-disturbance agreements typically have carve-outs in it where the lenders say they will not be bound by offsets that are set forth in the lease. And there are qualifications that you can typically negotiate into the document, particularly if it's a continuing situation. The lender will often say, okay, once I've taken over the property, well, then I'm bound by the lease and the offsets that accrue during my period of ownership. So the commission may become an obligation during that shoulder period of time. And one installment could be at risk and perhaps the second installment not, depending on the payment schedule. Any more questions? So again, the challenges the owners are confronting, you want to attract, tenants to your building and let them know that you're, solid as a rock. And of course, the people that own the buildings that, right, you gentlemen and ladies like to put your tenants into didn't get to own these buildings by not being good operators and not knowing how to be best in class. And of course, it behooves the owners to let everyone know their track records and their, how solid their balance sheets are. And, and communicate that, to the community, because those things travel fast and gender goodwill. And of course, if you can offer 100% commission on signing, that will not guarantee you'll get a deal that isn't appropriate, where the space doesn't work for the tenant, but it may get your space some additional looks. It may entice some of the professionals in the market to say, well, maybe I should give that building another look, and that's helpful. But of course, the bottom line is, the space has to work for the tenant, and all of the capacities there need to suit their needs. And of course, everybody is wondering how local law 97 is going to play out in practice. And I think a lot of people have handles and projections on where their numbers are going to play out, but being transparent with that information is useful because people are projecting their costs over 5 and 10-year timelines. And the great question in my mind, and I'm sure a lot of people are asking themselves, is what's the value of the amenities that people are investing in? Are they meaningful, or is it a necessary evil, whether you need it to just level the playing field, whether there's a return on investment there or not? If the landlord, files bankruptcy, the results are kind of different than if the tenant files bankruptcy. And Kirk, I'll turn this slide over to you.
Yeah, look, you don't see a lot of landlord bankruptcies for a couple of reasons now. I mean, of course, you have the recourse carve-out guarantee where, owners have a creditworthy entity up on a guarantee that if they do bad things, and bankruptcy filing is a bad thing in this context, there's full recourse to the guarantor, which could be a fund or something creditworthy that they care about. So that is a prime deterrent, practically speaking. But the other thing is that, the landlord bankruptcy doesn't really do a whole lot. You can't really get rid of a tenant, for example. A landlord that files for bankruptcy, if it purports to reject a lease, the tenant can stay. The tenant can stay for the entire lease term and all extensions. And if, the landlord may want to try to get out of providing some of the services, but the tenant can just provide this, do the services or pay for the services anyway and offset. So it doesn't do a whole lot. So that's those are some primary reasons why, you don't see a lot of bankruptcies. And of course, the bankruptcy code was amended. I used to say it was recently amended, but now it's really not recent anymore, to make single asset real estate cases, much faster and sort of harder to proceed with it, and in a way that would provide a meaningful, advantage over lenders.
So on your second bullet point, effects on the tenant, says, but can elect not to provide services. Is that so?
Well, the landlord can provide no services, okay, but then the tenant can just pay for them anyway and offset.
Oh, I see. Okay.
Okay. So, you ask yourself, well, what's in it for the landlord then? I mean, it's paying for it anyway. Okay.
And to Kirk's earlier point about non-recourse carve-outs and coming back to CMBS loans, the CMBS loans are typically non-recourse, but there are a number of events where the loan becomes recourse to the borrower or the principal of the borrower, whoever provides that guarantee, whether it's a moneyed entity or an individual. And one of those recourse events is the filing of a bankruptcy by the landlord. And often in loans of CMBS loans of a certain size, they require one or more independent directors whose sole role is to be an independent voice to vote upon whether or not this landlord should file bankruptcy or not. So that's why the landlord bankruptcies are exceedingly rare in today's environment. And even lenders who are making, what Michael Cohen referred to as portfolio loans or balance sheet loans, they've adopted the securitized loan documents because they don't know if one day they may want to put these loans into a package and securitize them. So in a lot of respects, those are guardrails have, prevented a lot of landlord bankruptcies. And so you just see people giving back the keys more often.
I think, Michael, one of the things that I would suggest here is even before, that's the landlord going bankrupt is DEFCON 2, and that's you're done. It's the triggers that are going to occur before once they go into default, before they go into bankruptcy, before they go into foreclosure. And one of the biggest things that is going to affect the people on this call is if they're in a default, there's the lender, especially in CMBS, has the right to replace and put a receiver in place, and who can change the leasing and the management of the building. And I don't know, that would be my question for you guys, is what happens then? What happens when you don't have the right to do this anymore?
Well, that's great. That's a perfect segue to the next
Yeah.
slide.
Yeah.
So thank you for that. And Kirk, since as our distress expert, you want to continue on that?
Yeah, I mean, look, just on the narrow point of a receiver, I mean, that's usually what a mortgage holder, has the right to do. And it's in CMBS, of course, but it's also in other mortgage docs as well. I will say that mortgage lenders have to ask themselves whether or not they really want to put a receiver in. I have been involved in a whole bunch of matters where the mortgage lender has decided not to. For example, during COVID, when there were defaults all over the place, those defaults were not attributable to sort of a deficient management style or management capability of the owner or the property manager. It was just COVID. And so if a receiver went in to take over, there's not really anything that a receiver is going to do any different, unless it had a cure at the time. So that is something that people think about. But in non-COVID times and other times, yes, a primary remedy for the lender is to bring in a receiver. And look, with distressed real estate generally, I mean, there are different ways that people go, or different ways in which a property can be in distress. Obviously, one is the mortgage loan, and the remedy is the foreclosure of the mortgage, and a new entity takes over the property. Second, I'm going a little out of order from this little bullet point. The second is the deed in lieu, which is the circumstance where the property owner basically says, look, you want the keys, lender? Here you go. And typically the structuring of that is a little technical, but usually the lender keeps the mortgage alive and has a different entity take over the actual ownership. But the idea there is usually the lender will give some kind of cookie to the owner to advance the process for foreclosure. I don't know if you all, are following sort of the timing of things, but a foreclosure in the state of New York takes, forever. I used to, years and years ago, I used to say 12 months, if the borrower does absolutely nothing, then it became 18 months. Now it's more like, 24 to 36 months if the borrower just absolutely doesn't depose. So there is a benefit to the lender to going quickly and offering cookies to get the deed in lieu.